Okay, cool. All right. Let me. Uh, Amal, I really suggest that you write these notes down because you will not be able to carry your screenshots when you go to an interview. Yeah, it's better that you write all of this down. Okay. So again, to recap, cash equities. Why is it called cash equities? It is considered as a near cash instrument. Okay. So if you buy or sell equities, it takes 2 days for the cash and securities to go out and come in. Okay. In the sense, if you buy 500 shares of ICICI Bank on Monday, on Wednesday, the money will go out of your account, and on the same day, securities will come to your depository account. Okay. Cash equity, share stock, common stock, ordinary shares, all of that means ownership. Okay. And what does the company get? They'll sell their equity for cash. Okay. Yes, only in the primary market the company gets cash, not in the secondary market. Okay. All right. Now, very quickly, what are the advantages for a shareholder? Can anyone tell me? Okay. Ownership, dividend, they can vote, voting rights, correct? What else? Very good. So, capital appreciation. Okay. Okay, takes the decision part. So, that decision making is again voting rights. Okay. Anything else? Okay, capital appreciation and revenue recognition. Okay. Anything else? So, you guys are all you got it perfect. That's very good. Yeah. Well, sort of not economic growth, rather, your shareholder. So the economy doesn't grow as such like that. Okay. Yeah, Shreya, very good. Limited liability. Yes. All right. What else? Okay. Actually, not bad. You guys got all the major points. Okay. So when you talk about advantages of a shareholder, right? So what do they get? Ownership, return in the form of dividends, voting rights. If the company defaults, they might, okay, again, I've used the word they might get access to the funds, okay. Then there's transferability. Now, what do we mean by transferability? So now let's say that I own ICICI Bank shares and there's a lot of bad news about ICICI and I feel, you know what, I think the share price is going to go down. So I can just transfer the shares to somebody else who has the opposite view. Okay, who has the opposite view, thinking that, hey, you know what, I think somebody else might think, okay, ICICI Bank shares are going to go up. Okay, so in order for the secondary market to work, right, one person has to be bullish and the other person has to be bearish. Okay, that's how stock markets work. Okay. Next, you have limited liability. Okay. Now, what does this mean? Now, let's say I spend 5,000 rupees on buying ICICI Bank shares. Now, what is the maximum loss I'm going to incur? Yeah, correct. Yeah, so it's going to be 5,000 and nothing more than that. Okay, it cannot be more than 5,000. Okay, so that's what we mean by limited liability. Okay, and the most important part in terms of advantages for a shareholder, right, is capital appreciation. Okay, now what does capital appreciation means is that let's say you bought 1,000 shares of company ABC at $10. Now, what's your total investment? $10,000. Now, let's say after 5 years, the price of company ABC shares go up to $40. Okay, then what happens? Your total investment now has become 40,000. So, how much profit did you make? Yeah,
$1,000.
yeah, $30,000. Okay. Cool. So are you guys clear with this? Advantages for a shareholder is in terms of ownership, returns in the form of dividends, voting rights. If the company defaults, they might get access to the funds, okay? Transferability, limited liability, and capital appreciation, okay? Take a minute and write this down and let me know when you're done. Jackson, you have a question? Okay, another 30 seconds and we'll move on. That's okay, Jackson. Only 3, 4 done. 5. Okay. Now, can anybody tell me what are the disadvantages of being a shareholder? Okay, capital loss. Okay, what else? Well, okay. So, so Deepesh, this company. So one thing, guys, let's be clear with one thing. In your college days, right? The only thing lot of you have, I mean, pretty much across the country is that company will default. Company will default. Company will default. Okay, but you got to understand that only during severe economic crises and issues, right, is when companies might file for bankruptcy. Okay, but otherwise, you don't hear about companies going bankrupt every day, right? Right? You don't hear that. Okay. All right. So when you talk about the disadvantages for a shareholder, right? Now, some of you might find it shocking is that one of the disadvantages is also an advantage, which is ownership. Now, why ownership? Is because ownership is limited to the number of shares that you have. So if you hold 100 shares of ICICI Bank, right, you're not a majority shareholder. Okay. Now, if you own, let's say, 50 million shares or 100 million shares of ICICI Bank, then you're a majority shareholder. Okay. But if you own 50, 100, even 1,000, even 5,000, or even 10,000 shares, right? For us as retail investors, that's a lot of money, right? But if it is, even if you own 10,000 shares, right, it really means nothing in the long run and in the grand scheme of things. Okay. All right. Now, the next thing is again both an advantage and a disadvantage is that it's dividends. Okay, so dividends will not necessarily be paid every year, and it is left to the board of directors if they want to pay or not. Okay, so dividends is never ever guaranteed. Okay, and the last one, like some of you mentioned, right? Capital depreciation. Okay, So, meaning the share price going down, so you lose the amount of money you've invested. Okay. Well, yeah, you can also consider voting rights can be a disadvantage because still majority of the shares are held by the founder or the owner of the company. Okay. So, are we clear with the disadvantages of being a shareholder? Okay. So, write this down and let me know when you're done. Okay. Cool. Most are done. All right. Okay, so now let's break down equity. Okay, so or shares rather, right? Now, I don't know if you guys know this, but there are two different types of shares. Okay, one is what we call as preferential shares, and the other is equity. Okay, now when we talk about preferential shares, right? Preferential shares, it is done through private placements. Okay, now anybody have an idea of what is private placements?
Sir, in which only investors who are knowledgeable about markets are allowed to
Okay,
invest.
okay. Anything else? Okay, good. So basically, when we talk about preferential shares, right, it goes through the private placement route. Okay, basically, only qualified investors will be allowed to buy preferential shares. Okay, and who are these qualified investors? They can be angel investors, hedge funds, it could be financial institutions, foreign institutional investors. All of those guys are your get access to the preferential shares. Okay, and that's done through the private placement route. Okay, and when we talk about equity, right, it's done through the IPO process. Okay, so when we talk about the we will talk about the IPO process later, but the IPO process is more for us, the retail investors. Okay, uh, the retail investors don't necessarily have access to private placements. Okay, why? Because largely the amount of money that they require, right? They need huge sums of capital. So that is why retail investors don't participate in preferential shares a lot. Okay. Now, can anybody tell me what are the advantages of owning preferential shares or having preferential shares? Okay, dividend. Rather, to be clear, fixed dividend. Good. High success rate of decisions. What do you mean by that, Deepesh? Okay, you get preferential voting rights. Good. Biswajit, sorry. No change on assets. Purchasing at a lower price than market price. Anurag, what do you mean by that? I didn't understand.
I think they can buy the shares at price which is less than the market price, the price which is currently at the stock price.
Mhm.
So I think they can buy.
No, no. So let me be clear, guys, is that your preferential shares, most of them, right? They don't trade on the exchange. However, there are some that do, but on an generally, right? Preferential shares do not trade over the exchange. Okay, they don't trade over the exchange. They are done. It's all privately held, so that's why it's called private placements. Okay, so when we talk about the advantages of preferential shares, right? So you have ownership, you have preferential voting rights, and you get fixed dividends. Okay. And one of the interesting things is that you get paid before the ordinary shareholders. Okay. So when you guys look at the structure, right, with any company, what happens is that first and foremost, they have to pay all the taxes. After that, they have to pay to the creditors. Okay, and then your bond holders. So even in that bond holders, you have secured bonds and unsecured bonds. Okay. Then your preferential shares, and then finally your equity shares if there is any money left. Okay. All right. Now, what do you think are the disadvantages of owning preferential shares? Okay. No voting rights. Correct. Good. What else? So tax is always a disadvantage. So even if you're an equity shareholder or a preferential shareholder. So that's something you cannot run from.
Sir, why fixed dividend is no disadvantage of preference shareholder?
Yeah, because an equity preferential shareholder, a normal equity holder, equity shareholder, can get more returns by holding equity than preferential shares.
But sometimes they fail to provide dividends to the equity shareholders.
Yeah.
Okay.
So now, see, the idea is that dividends get paid when company has profit when they've done good amount of business in a quarter and they're profitable. Then they can decide if they want to give out dividends or not. Now, for the preferential shareholder, even if they make amazing profit or less profit, it is fixed. There's no change in that. But however, for the equity shareholder, the percentage of dividend can change and vary. Okay, all right, correct, Shreya. Okay, Shreya, sorry. All right, so your disadvantages are fixed dividends, no voting rights, and also it's not transferable. Okay, it's not as easy to transfer as normal equity shares. Okay, are we clear with this? What are the advantages and disadvantages? Okay, take a minute and write that down. Saurabh, I don't understand your question. What do you mean transfer of share? Which share? Are you talking about preferential shares or equity shares?
In equity. I'm talking about equity. Equity share I'm talking about.
Yeah, so it's the same thing, Saurabh, is that if you bought the shares, so you just have to go to your broker and sell the shares.
Okay.
Correct, Amal. They don't have voting rights. So Anurag, why don't you tell me? I think that's pretty clear, no? Why? Can you tell me why it's both a pro and a con? I just mentioned it.
Please tell once more. It is not clear.
Sorry?
Sir, I'm not clear. So can you please tell once again?
So why does both advantage and disadvantage is that it could be that the company gives so let's say company has done a lot of profit, they've done very good and they have more profit. So even if they've made more profit, right, the preferential shareholder will still get a fixed rate, whereas the equity shareholder can get more.
Okay, sir, understood.
Okay, let me know when you're done. So Shreya, not transferable means it's difficult to transfer to other people within the basically you cannot transfer to other people. Okay. All right. So next what we'll do is we'll talk about the different types of preferential shares. Okay. So there are in total 8. Okay, and you guys have to know all that 8. Okay. So the first one we're going to talk about is cumulative preferential shares. Now, what does that mean is that if you're a cumulative preferential shareholder, you get paid all the missed dividends. And on the flip side, it's two sides of the same coin. A non-cumulative preferential shareholder does not get paid the missed dividend. Okay. Now let's look at this example that I have given here. Okay. So cumulative preferential share, non-cumulative preferential share, and equity shareholder. Okay. Now in 2020, they did not pay dividends to anyone, so nobody got. In 2021, no dividend was paid out. Okay. Now in 2022, okay. Now please be clear on this. The cumulative, this guy, the A cumulative preferential shareholder, okay, will get $10 for 2020 because that was missed, $10 for 2021, and $10 for 2022. Okay, so he get paid all the missed dividends. Okay, and a non-cumulative only got paid for 2022, and the equity shareholder got paid for 2022. Okay, is this clear with everyone? Okay, take a minute and write this down. We still have 6 more to go. Yeah, correct, Saurabh. The company dividends again. Let me clarify your BCom knowledge. Okay, so no company is under the compulsion to pay dividends. Okay, only when they make a reasonable amount of profit, and then that too after giving out dividends, they have enough money. Then only they will give out dividends. Otherwise, they will not. I think Microsoft, right? If I'm not mistaken, they paid their first round of dividends after 17 years. Yeah, after 17 years, they paid the first round of dividends. Okay, all right. Let me know when you guys are done. Okay, cool. All right, now let's move on to the next one. The next one is participating preferential shareholder. Okay, now the participating preferential shareholder gets access to additional dividends. Okay, and dividends is nothing but profits. And the non-participating preferential shareholder does not get access to additional dividends. Okay, now let's. I've given you guys an example here. All right, now you have company A, same example I'm taking, 2020, 21, and 22. So participating preferential, so in 2020, no dividends were declared, so nobody got paid. In 2021, same thing, nobody got paid. Now in 2022, they had a very good year. Okay, so what happens is that, let me hang on, take this out for a second. Okay, so what happens, please pay careful attention here, is that in 2022, the company will pay out dividends to everybody, the participating, non-participating, and equity shareholder. Now, after paying everybody, if there is money left over, the participating preferential shareholder will get those additional dividends. Is this clear with everyone? Okay, and it's only him who gets it, nobody else. Okay, so the idea is the company pays everybody, participating, non-participating, equity, and after that, if money is still left over and they want to pay that out, then the participating preferential shareholder will get those additional dividends. Is this clear with everyone? Okay, Saurabh, what is it that you didn't understand? Okay, so participating preferential share.
Dividend part, sir.
Sorry. Saurabh, say that again. I didn't hear you. Okay, let me explain it again. So when we talk about a participating preferential shareholder, they get access to additional dividends or additional profit. Okay, so if you are, so let's say we're talking about company A, right?
Right.
So in 2020, no dividend is paid to anyone. In 2021, again, no dividends paid to anyone. In 2022, okay, what happens is that the company pays the dividends, okay, to all of the participating, non-participating, and equity shareholder. Okay, yeah. So they paid dividends. Now, if let's say more money is left over, okay, then they will pay them that additional money.
Yeah. Okay.
That's true, Vibhor. I don't think any in 2020, nothing is going to happen. Is this clear? Yes, yes, Shreya. They can decide to. This thing is completely the board of directors' decision. Okay. Yeah. Retain earnings. Yeah. All right. Now let's move on. The next one, the third set rather, is what we call as redeemable preferential shares. Okay. Here, redeemable preferential shareholders will get their money back. Okay, to the amount they invested at the time of maturity. Okay, so again, redeemable preferential shares holders will get their money back to the amount they invested at the time of maturity. Actually, that's a little the same. Holders will get their money back at the time of maturity, and a non-redeemable preferential shareholder will not get their money back. Okay, so redeemable preferential shareholder will get their money back at the time of maturity. Now, generally, the maturity is somewhere between 15 to 20 years. Okay, and the price is also pre-decided, rather how much money they are going to give back, and it will be generally the amount that they have invested in. So if I bought, let's say, 10 lakh rupees worth of redeemable preferential shares, 15 years from now I will get the 10 lakhs back. Okay, but a non-redeemable will not get that. Okay, but now let me ask you guys a question. So if I'm giving 10 lakhs and let's say I'm redeemable preferential shareholder, so I give the 10 lakhs and I get 10 lakhs back. Did I make any profit? No, Amol, the value of inflation is not corrected. Now, during those 15 years, am I going to earn anything or no? All right, good, good, good. Yes, I will get the dividends. Okay, good. So I'll get the dividends for those 15 years. Okay, and a non-redeemable preferential shareholder will not get their money back, but what will they instead get? What about the non-redeemable? They won't get their money back. Yes, good, good. So Vipur got it. It's that they will keep getting the dividends forever. Okay, is this clear with everyone? Okay, and the last two is what we call as convertible preferential shares and non-convertible preferential shares. So pretty easy. This convertible preferential share can be converted to equity shares at the time of maturity, and non-convertible preferential shares cannot be converted to equity. Okay, is this clear with everyone? So different types of preferential shares: cumulative, non-cumulative, participating, non-participating, redeemable, non-redeemable, convertible, non-convertible. Okay. All right. Take a minute and write this down. Please don't screenshot. Write it down for your own good. Yes, they only get dividends. Deepesh, please try and understand the concept. Is that only when they're profitable they'll pay dividends, but otherwise they're not going to get dividends. Yeah, that's the risk. But if you're cumulative, if you hold cumulative, you get the missed dividends. Well, Amul, see, bonds is completely different, and redeemable preferential shares are completely different. You cannot compare them. Okay, these are two different financial instruments. No, no. Whatever we just talked about, right? It'll have generally. I'm talking about the main features. That's it. Okay. Let me know when you guys are done writing. Yeah, but Amal, what Vibor is trying to say is that these are two different financial instruments. It's like saying apple and banana are the same thing, right? So if you say apple, that is equity, and if you say banana, that's a bond. So you cannot compare an apple and a bond, right? Two different this thing. Okay, are we clear? Okay, the next thing that we're going to talk about, okay, is something that you guys really, well, you guys need to start reading about it and start understanding a lot of things, okay? So next thing that we're going to talk about, this primarily has to do with the secondary market, okay? Is what we call as market capitalization, okay? Now, what is market capitalization? Basically, it stands for, it's like a formula rather, right? It's the number of outstanding shares into current market price, okay? It gives you a rough estimation of the value of the company, okay? So when you say number of outstanding shares, that means that it's the number of shares currently being traded in the market and whatever is the current price of that share. Okay, so it's a rough estimation of the value of the company. And as email homework, right? Okay, homework. Okay, please find out the market capitalizations of the following companies. Okay, so let's talk about Tesla. Tesla has been in the news. Okay, Reliance, Apple. What else? Um, HDFC Bank. Okay, Microsoft. Okay, all right. So find out the market capitalization. So basically, you need to figure out the number of outstanding shares and the current market price. You multiply that, and you will get the market capitalization of the company. Okay, so Tesla, Reliance, Apple, HDFC, and MSFT. MSFT is Microsoft. Okay, let me put it as Microsoft. Okay, any other companies that you guys are you find you're partial to or you like? No? No, no company that you guys are partial to. That means more homework. Okay, fine. All right. Okay, cool. So, are we clear with the idea of market capitalization? Okay, that's 3 people. I think there's like 20 plus people. I'm only talking to like 4 or 5 people, I think, in this group. No. So whatever. So Shubham, it's the shares that are there in the market, not the unsold shares. That's something else. Okay, that's something else. All right. The next important thing within the secondary market is that there's a term called as index. Okay. Now, what do we mean by an index? Anybody have an idea?
Average,
Average of what?
the companies or commodities.
Commodities. Not like that, my friend. Okay. So when you talk about index, right, it refers to a statistical measure of change in the securities market. Okay. Now, in India, we have different indices. Okay. And the 2 major indices are, anybody know? The 2 major indices in India?
Sensex and Nifty 50.
Yeah.
BSE and NSE.
Yeah. So Nifty 50 on NSE and Sensex 30 on BSE. Now, where did this 50 and 30 come from? What is this 50 and 30?
So these basically are a combination of 50 companies, and Nifty 50 is a combination of top 50 companies which have the top 50 market capitalization in the
Ah,
market right now.
good. Yeah. So when we talk about Nifty 50, that 50 stands for the top 50 companies in terms of market capitalization. And Sensex 30 is the top 30 companies in terms of market capitalization. Now, because we have 2 different exchanges, right? Largely the same shares are traded on both the exchanges. Okay. Now, you guys might have heard of other indexes as well. There's something known as Bank Nifty, Nifty Pharma, Nifty IT, Nifty Auto. All of those are different indexes. Okay. So Vibhor, it's not an average. Okay, it's a statistical measure. So, well, it's a little difficult to because there's a lot of math involved in this. Okay, but on a very like you can say in a very generic way, right, that it is an average. Yeah, it is a average of all the top 50 companies. Okay, all right. So are we clear with this? What is an index? What are the different types of indices? Now, for additional email homework, right? I know you guys don't like it, but that's the only way your knowledge is going to improve. Okay, email homework. Okay, find out the top 10 major uh, indices of the world. Okay, so why I'm saying of the world is because some of you know quite a bit about Indian markets, but you have zero knowledge on international markets. Okay, so find out the top 10 major indices of the world. Okay, all right. Now, the last bit on the secondary market side, right, is what we call as large cap, mid cap, and small cap. I think a lot of you might have heard of this. So when we talk about large cap, right, what does that mean? Is that any company whose market capitalization is greater than 10 billion US dollars. Okay. Mid cap is anything between 2 billion to 10 billion. Okay. And small cap is anything less than 2 billion. Okay, is this clear with everyone? And are you guys clear with the second email homework? Find out the top 10 major indices of the world. Okay, all right, take a minute and write this down and let me know when you're done. Deepesh, I didn't understand your question. What do you mean large cap for what? No, 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 not to invest or raise. See, companies like Reliance is considered as a large cap. Why? Because their market capitalization is greater than 10 billion. So it has to do with the value of the company. Give me 1 second. Everybody done? Okay, cool. Okay, now let's move on to the IPO process. Okay, now when talk about the IPO process, right? Let me set some back context in it. Okay, uh, so it's not that every company is eligible for an IPO. Okay, even if it is very profitable, right? Not all companies are eligible for an IPO until and unless you meet the regulatory requirements. So what we'll talk about is the Indian IPO process. Okay, so if you meet SEBI's regulatory requirements, then only you can go through an IPO. But if you do not meet the regulatory requirements, right, you will not be allowed to do the IPO. Okay, is this clear with everyone? Okay. So until unless you meet the regulatory listing, now then only you'll be able to do an IPO. Now here's the other thing is that each country has their own rules. Okay, each country has their own rules, and it's like honestly impossible to learn all the rules of all the markets, right? But as and when you get experience and you start doing activities within that, right? Then only you'll start understanding this thing. Okay, Shreya, I'll repeat again. So what I was saying was that not all companies are eligible for IPOs because they have to meet certain regulatory requirements. Okay. Now, until unless they meet the regulatory requirements, right, they will not be able to go through the IPO process. Okay. Yeah, so we'll talk about the regulatory conditions now. So we'll talk about some of the basic ones. Okay. So the first one, and I'm going to talk specifically about Indian markets, okay? Because like I mentioned before, each market has its own set of rules and regulations. So but for now, for you guys, let's just focus on Indian markets, okay? For this part, okay. All right. So let's look at some of the rules and regulations, okay? Now, who gives out these rules and regulations? Can anybody tell me? All right, very good. So SEBI is the one that gives out these rules and regulations, okay? Not stock exchange, not depository, not RBI, not anyone, okay? All right, everybody got it. Good. All right. So the first rule is that the net tangible assets of at least rupees 3 crores in each of the preceding 3 full years, okay? What does this mean? Can anybody interpret that? Net tangible assets of at least 3 crores.
Their equity shall be at least 3 crores or more.
Sorry?
Equity shall be above 3 crores.
Equity share.
And so equity is net assets.
Okay. Okay. Net assets is at least 3 crores. Okay. Okay. So that's the first rule. Second rule is that minimum of rupees 15 crores as average pre-tax operating profit in at least 3 years of the immediately preceding 5 years. Okay. So what does this mean? Is that minimum of 15 crores as an average, which is pre-tax profit. So you should at least make 15 crores profit before tax for at least the last 3 years. Okay. Now, if you look at it, right, though there are a lot of successful companies in India and there are a lot of businessmen, right? I don't think a lot of companies do 15 crores worth of. They have a profit of 15 crores on a yearly basis, right? And that too, they have to maintain that for at least 3 years, right? Now, honestly, if I can run a business and I can make 15 crores every year, I would run that business exactly for 5 years and I would retire. I would definitely do that. Yeah. Next one is yes, Biswajit, 3 consecutive years. Okay. Next one is that the net worth of at least rupees 1 crore in each of the preceding 3 full years. Okay. What does this mean? Any idea? Net worth of at least rupees 1 crore. So the question is, what the net worth of the third rule is net worth of at least rupees 1 crore in each of the preceding 3 full years.
PAT, sir.
Sorry?
PAT.
VAT. Okay. Value added tax. Okay. Yes, Lakshmi, I will send you the notes after class and the recording as well. Don't worry. Okay. Oh, PAT. Okay. Profit after tax. Okay. I heard VAT. Okay. Cool. All right. So here are the rules and regulations of the IPO process for India. Okay. So there are a lot of other points, but these are your 3 major points. Okay. Net tangible assets of at least 3 crores, minimum rupees 15 crore as average pre-tax profit, and net worth of at least 1 crore. Is this clear with everyone? Yes, no? All right.
So what is pre-tax operating profit?
Pre-tax operating of, so before you pay tax, whatever profit that you earn. So it's like gross. Well, think of it, it's gross basically. The gross profit, then you pay out your taxes, then you get net profit, right?
So yes, exactly.
Yeah. So that's what it means. The legal language, it's very difficult. It's you can easily misinterpret it. Okay. Please take a minute, write this down, and we'll move on to the next bit.
So the point B is not clear to me. Can you please recap point B?
Sorry, I was on mute. Okay. No, we were just talking about this, right? So what that means is that, see, you have a gross profit, then you pay your taxes, then you come to net profit. So your gross profit should be minimum 15 crores for the last 3 years. Is that clear? Okay. Let me know when you guys are done. It's always PAT. Yeah, but what can you do, Amul? The taxes are very high in India. By the way, I don't know if you guys know this, right? Is that uh, in India, because of competition, right? It's very, very tough to do business, and it's really tough to actually make like good profit, right? Uh, like in the US, right? Most people, any business that you open up has anywhere between a 15% to 20% profit. Okay, but in India, due to competition, right, it is anywhere between, I'd say, 3 to 5%. Correct me if I'm wrong. If some of you come from a business background, I think I'm close to that. So most business in India, right, it's like a 3 to 5% profit margin that they make. But in the US and the Western world, right, it's somewhere between 15 to 20%. Yeah? And so that's why, if you guys notice, right, in India, a lot of people do the volume business. So even though the margin is low, you do volume, you can eventually make quite a bit of money. Okay, are we done? So a good question. So why is the GDP stagnant? Is largely because, see, when the country is completely developed, right? See, now the thing is with the US, right? Uh, it is a developed country, but there's still a lot of development. There's a lot of breakdown in that country as well, which they don't necessarily develop. You see, a lot of times, right? You can develop something, but if you don't maintain it, right, it'll break down. So I wouldn't say that the GDP is stagnating because, see, the GDP keeps fluctuating based on how the economy is, what kind of jobs, all of that, right? So I wouldn't say it's stagnating. Rather, what you need to look at is its what is it? What do you call it? The size of its market, right? So the U.S. market, I think, is somewhere around $11 trillion, whereas India is just, I think, 2 or 3 trillion. So in terms of market, right, the US is huge. The number of transactions that happens in the US markets in a single day does not even happen. We finish that in one like half an hour. So in the US, right? So if they do like they can do like 50 million or 100 million transactions on the stock exchange. India, right? We won't even hit 10% of that. Okay. All right. Now let's move on. The next one that we'll talk about is participants of the IPO. Okay. Now let's take an example. Okay. Now let's say that all of us, okay, we started a company, and let's say that we met the rules and regulations. Okay, the minimum rules and regulations, and now we want to go public. Okay. So what's the first thing that we're going to do if we are going to go public? Who should we hire? Correct. Okay. So yeah, and that's also correct. So underwriting is basically a function, okay, that a investment bank does. Okay. Now, what we call them, we'll use a different term. We call them as lead managers. Okay. Now, lead managers are companies like Goldman Sachs, Morgan Stanley, JP Morgan, Society General, etc. Northern Trust, not Northern Trust and all that. I'm sorry, not much, but these are largely your main investment banks. Okay. Now, what are some of the functions that they do? They do underwriting, they draft the prospectus, and they drive roadshows. Okay. Now, what does underwriting mean? Can anybody explain in a very simple manner? Let me see if you guys have a clear understanding.
So on behalf of the company, they help the company to raise the sufficient funds from the market to subscribe the uh, requirement that is 90%.
Oh,
90% of the capital should be raised.
okay. Then what? So what does that underwriting mean then? So you're saying the right things. Okay, but what else? Okay, so Shreya's got the right idea, is that it undertakes the risk. Okay, now what is the risk is that what if the shares don't get sold in the market, right? If the shares don't get sold in the market, that's a risk to the company. So when you say underwriting, what that means is that the investment bank will underwrite the issue. Means that if in case they are not able to sell the shares, okay, the investment bank will end up buying them. Okay, now generally it's about 10% is what they underwrite, but you got to understand that 10% is a huge amount of money. Okay, huge amount of money. Okay, all right. Are you clear with underwriting? Okay. All right. So Saurabh, IB, they get very, very nice fees. Very, very nice fees. Yeah. Okay. Next, what do we mean by drafting prospectus is that they will help. So basically, the company's management, okay, company's management and the investment bank will sit down and they'll create a prospectus. Basically, this prospectus has all the important information regarding the company, okay, of all the what business they're into, how much profits they've earned, what are the taxes that they've paid. So they basically give an entire um, overview of the company. Okay, that's what we mean by draft prospectus. Now, what do we mean by drive roadshows is that when we talk about driving roadshows, basically they will promote the company to to institutional investors, to hedge funds, to the Warren Buffetts of the world. Yeah, yeah. So that's what we mean by driving roadshows. Yes, exactly. Investor pitch, exactly. So Amul, that's a separate topic. So that comes under private placements, right? So they do fundraising where they go out to venture capitalists, private equity guys, and they ask them, promote their company, and they ask them to invest in it. Okay. Yeah, and it's also called as a red herring prospectus. Now, red herring is actually a type of fish. Okay, now I'm not sure why they use that term as red herring, but it's called as a red herring prospectus. Not reed, but red. When you guys look at your notes, right? Herring prospectus. I think there's an explanation on that. Sure, Ganesh. So again, draft prospectus is basically they are giving an overview of the company. So the investment bank and the company sit down and they create this prospectus. Okay, and this is the prospectus that will get submitted to the regulator for them to approve to go through the IPO process. Okay, and when we talk about roadshows, basically they will promote the company to all the institutional investors, foreign investors, Warren Buffett's, hedge funds, asset management companies, etc. Okay, so that's what we mean by drive roadshows. Okay, is this clear with everyone? Okay. All right. Now, who do you think should be the second person to, you know, or the second participant we have to hire? Well, auditor and all that is there. I don't disagree with that. But anybody else? So auditor, legal team, all of that will be there. But apart from that, no. Okay. They're not. So we're not going to hire a retail investor. Rather, what we need to do is that we need to contact another group of members, right? Participants to help with the retail side. Okay. And what we call that is syndicate members. Okay. Now, syndicate members examples are like ICICI Securities, Zerodha, Sharekhan. Now, what do? They face the public and promote the company. And their customer base is retail investors. It's you and I. Okay. And then finally, they collect all the potential bids of the IPO. Okay. So this is what we mean by syndicate members. Okay. So we have lead managers, which are your investment banks, and your syndicate members are your ICICI Securities, Zerodha, Sharekhan, etc. Okay, and they promote it to the retail investor. Is this clear with everyone? Is this clear? Okay, so after our syndicate members, right, you are going to hire the next one, okay, which we call as registrars. Okay, now the registrars are, what do? They do the record keeping of the IPO process. Okay, they do the record keeping of the IPO process. Okay, and finally you have bankers. Okay, now when I say bankers, these are not the investment banks. Okay, this is like State Bank of India, Axis Bank, ICICI Bank, all of that. Okay, now what do is that they maintain the bid amounts in an escrow account. Okay, now what is an escrow account? Means that it is only created during the time of the IPO process, and we call that as a temporary pass-through account. We call that as a temporary pass-through account. Okay, so registrars, they do the record keeping of the IPO process. Then bankers, okay, so bankers are like SBI, Axis, ICICI, etc., HDFC, and they maintain the potential bid amount in an escrow account. Okay, and an escrow account is only done during the IPO process. Okay, and we call that as a temporary pass-through account. Okay, so Deepesh, what do you mean? Who's they provide a platform for trading? You mean syndicate members? No, so there's no platform for trading. It rather, what it is that you send your application to get the IPO shares. Okay, you send your application to get the IPO shares through your broker, and they will submit it on your behalf. Okay. Okay. I'm a straightforward. Bankers, they maintain all the bids in an escrow account. Okay. Now, what is an escrow account? We call this as a temporary pass-through account. Basically, this is where all the cash and securities are held. So the securities from the company are put into the escrow. Cash from the investors are put into the escrow. And every time a bid is matched, right, between the investor and the company, then the shares and cash move out of the escrow account. Okay, basically think of it as an account where both cash and securities sit, and whenever the bidding is matched, the cash and securities move. It's Vibhor. It's so Vibhor has a question: is that bankers appointed by whom? So again, all the appointment is done by the company and lead managers. Okay, Deepesh, lead manager is an investment bank. So they do the underwriting, okay, and basically when you say underwriting, right, it means that if the IPO fails, they promise to buy a certain percentage of the shares. They draft the prospectus. Now this prospectus is what gets submitted to the regulator, and they drive roadshows. Basically, they go and talk to clients and tell them to invest in the company. Okay, is that clear with everyone? Okay, take a minute and write all of this down and let me know when you're done. Again, the same thing. Investment bank and company. They are the ones who decide. Sorry, Deepesh, I didn't understand. What do you mean by DP and DR? Are you talking about depository?
Talking about draft prospectus and drive roadshows. I'm
Huh.
just a little bit confused between that and just not getting the point. What is you and the lead manager and the syndicate member? You can please explain me step by step. Then I can understand that.
No, so where are you going? Where are you getting confused? It's pretty straightforward.
I'm just little bit confused between underwriting draft prospectus in what case.
So
They
see,
do
hang on.
uh,
Underwriting.
okay.
See, the idea of underwriting is that now let's say that I want to issue 100 shares in the market, okay? But unless you come and say, you know what, Rakshit, go ahead and issue it, and if anything goes wrong, I will buy up the remaining shares. Okay, that's what we mean by underwriting. Is that in case the shares are not sold in the market, right? In case the shares are not sold in the market, the investment banks will end up buying it. So that's known as underwriting. Okay. Now, when you talk about draft prospectus, okay, do you remember in college? I think you still have it now. You used to get a prospectus, right? And in that prospectus, what did you have? You had the founders of the school, who's the principal, who are the lecturers, who's the HOD, what kind of facilities do they have. So that is a prospectus. Now, the same thing is that the lead manager, the investment bank, are drafting or creating the prospectus for the company. Okay, so this is the document that they're going to submit. Now, drive roadshows is they're going to go and talk to clients to say that, hey, you know what, buy shares of this company. Is it clear? Okay, all right. All right, the rest are done writing. So are we clear with the participants of the IPO? Okay, cool. All right, now that okay, now you guys tell me what's the next logical thing to do. Okay, you guys tell me. So we are eligible. So we met the rules and regulations. We hired lead manager, we hired a syndicate member, a register, a banker, an auditor, and legal team. Everything is done. What is the next most important thing to decide? What do you guys think? Okay, very good. Okay, good. So we have to decide the price of an IPO. Okay. Now, when we talk about pricing an IPO, right, there are two methods. All right, there are two methods.
Hello.
Okay. All right. There are two methods of pricing an IPO. Okay. First one is what we call as a fixed pricing method. Okay. Now, what this means is that the price is decided by the company and the investment bank based on competitors and the company's balance sheet. Okay. When we talk about fixed pricing, so investment bank and company will decide the price. Okay. And all the investors have to pay that price. All the investors have to pay that price. Okay. Is that clear? Fixed pricing method. Okay. Yeah, we'll come to the next one. Okay. So the first one is fixed pricing method. Okay. Now the second one is what we call as the book building method, or it's also known as, anybody else know what is also known as? Book building is also known as Dutch auction method. Okay, it's known as Dutch auction method. Okay, now how does that work is that the company and the investment bank will decide on a range. Okay, and we call this as a floor price and a ceiling price. Okay, now for example, I've put the floor price as $95. Okay, $95 and the ceiling price of 100. Now what does this mean is that no investor can bid below the floor price and no investor can bid above the ceiling price. Okay, so any bid that comes in, right, any bid that comes in has to be between 100 and 95. Okay, is that clear with everyone? Okay, so an investor cannot bid above 100 and cannot bid below 95. Okay, so what happens is that you can only the range is between 95 and 100. Is this clear with everyone? So when you talk about book building, you have a floor price and a ceiling price. So you cannot go below floor and you cannot go above ceiling. Well, you cannot. First of all, the rule is you cannot buy above the floor price. No. So why will anyone buy above floor price? Yeah, you can. See, because you can bid between 95. See, these are the prices. Okay. So the lowest you can bid is 95. You can bid 96, you can bid 97, 98, 99 and 100. So you have this range to bid. Okay. So 1, 2, 3, 4 and 5 price ranges. Okay, so you can, and it's not that just because you bid the highest, right, you will get the allotment. Okay, it really depends. Okay, and that's what we'll talk about next, is that when the book building method, no Dipesh, you cannot bid above ceiling. See guys, think about it this way. You have only between 95 and 100. It cannot go below 95 or cannot go above 100. Even if you try to do that, right, your bid will get rejected in the market. Okay, your bid will get rejected in the market. Okay, all right. So now let's say that we got allotment from, or we got the bids from various investors. Okay, now let's say that investor A, right, he wants to buy 100 shares. Okay, at let's say 98. Okay, investor B wants to buy 10,000 shares at 95. Okay, investor C wants to bid 100,000 shares at, let's say 100. Okay, now when we look at this, right, when we look at this, we received all these bids from various investors. Okay, and now see, I've just taken example of 3 here, but you have to imagine millions of people. Okay, now how will you decide who gets the allotment? Okay, how will you decide who gets the allotment is that you use a method called as discriminatory pricing method. Okay, now what happens in the discriminatory pricing method is that the shares will be allocated to the investors who give the highest quantity and then price. Okay, highest quantity and then price. Let's say 96. Okay, so now who will get the allotment first? When we use discriminatory method, right? So it is going to be investor D, yeah, because he wants 10 million shares at 96. Okay, then the next one will be C, then D, and then A. So they go down from the highest quantity to the lowest quantity. No, so Vibur, see, demand and supply, largely what that means is, see, it depends on the number of shares that the company is going to issue for the IPO. Okay. Now, how they determine the number of shares that they're going to issue is that the investment bank would have done research and would have figured out, based on previous companies doing a similar type of IPO in the same industry, of how much shares that they want to issue in the market. Okay. And also how much the company wants to lose ownership. Okay. So then what happens is that once that is determined, right, they will, the IPO starts, okay, and the bidding will start, okay. Now that is where this driving the road shows is very important, because that is what will determine your creating the demand for that, okay, demand for that. Oh, okay, you got it. Okay, cool. All right. Well, Dipesh, when you talk about who wants to invest highest money, is that also the other thing is that if somebody, now let's say, even if you say, a lot of times the allotment will happen to people who give the highest price, right? Because first criteria is quantity and second is price. Now, if I'm a retail investor, right, I cannot buy 10 million shares, okay, but I can buy it at a higher price if it is, let's say, 300, 400. So maybe I get lucky and maybe I get the allotment, okay. But this is basically how the pricing of an IPO happens, okay. You have a fixed pricing method and a book building method, okay. And then within book building, so please be clear, this is within big book building, is that you will use the discriminatory pricing method, okay, to figure out who will get the allotment for the shares. Is this clear with everyone? Okay, take a minute and write this down and then we'll move on. No, so Amul, you have to look at the quantity, because until unless you don't issue out all your shares, right, then only then will you be able to raise your capital. So the criteria has to be, the higher the quantity, see, basically, if I issue all my 100 shares, then logically I'll be able to raise my capital, right? So the focus should be on issuing out as much shares as possible, or the highest quantities first, and then looking at the price factor next. All right, shall we move on? Okay. So the next thing that we're going to talk about is, again, please don't get confused. We're moving to a new topic. Okay. So the next thing that we're going to talk about is something known as depository receipts. Okay, otherwise known as DRs. Okay. Now, what are DRs? Basically, these are issued to raise capital from foreign markets. Okay. Now, there are different types of depository receipts. Okay. So, for example, you have something known as ADRs, American Depository Receipts, GDRs, Global Depository Receipts, and IDRs, Indian Depository Receipts. Okay. So, when talk about depository receipts, they are issued to raise capital from a foreign market. Okay. Now, how does this work? Okay. Let's take an example. Right. Now, let's say that we have a company that is based here in India. Okay. Okay. So company A, which is based in India, and they want to issue American depository receipts to investors in the US. Okay, please listen to me carefully. Okay, so we have a company A here in India, and we want to issue ADRs in the US market. So what will we do is that we will approach a local custodian, which is here based in India, for example, SBI. And what we will do is we will release shares. Okay, we will release shares to the local custodian. Now, the local custodian will issue it to a global depository. Okay, and one of the examples of a global depository is called as DTCC, Depositories Trust Clearing Corporation, sorry, and they're based in the US. Now, what are they going to do is that they are going to convert the local equity to an American depository receipt, and they are going to issue the ADRs to the investors in US. Yeah, is this okay with everyone? So again, so you guys largely know that, okay, we have equity and you have preferential shares. Okay, those are two ways, and you have fixed income bonds as well to raise capital. Now, another way to raise capital is by issuing a depository receipt. Okay, now depository receipts are issued to raise capital from foreign markets. Okay, now you have different types: ADR, GDR, IDR, EDR. There's so many different types. Okay, now for example,
To raise capital from foreign markets through custodian.
yes.
You mean? Okay.
Okay,
Thank you.
sure. So you're using the custodian to raise the capital, but it's the investor in the US who's going to pay you the money. Okay, so you have company A based in India. Now, what are they going to do is that, hang on, they're going to release the shares to the local custodian. Okay, now the local custodian, what are they going to do is that, sorry, one second. The local custodian, what they're going to do is that they're going to take those shares and send it to the global depository. Okay, now which is based in the US. Okay, and an example of that is DTCC, Depositories Trust Clearing Corporation. Okay, based in the US. Okay, now what will they do is that they will convert the local equity. Now when I say local equity, I'm talking about the Indian local equity. What did I do? Sorry. Indian local equity to an American depository receipt, and that is what gets issued to the investor in the US. All right, is this clear with everyone? Yes, no? You guys answer this question to me. Why would a company do this?
To raise the capital from the foreign market.
Obviously, I've already told you that, but what would be the other reason for it? Guys, one thing with my questions, no, you have to think about it. So I've already given you the answer. Yeah, obviously it's from foreign markets, but what could be the reason why, apart from raising capital from foreign markets, what's the advantage they get? What is the advantage they get? Okay, they get listed in a foreign
Then
country.
they leave for
Okay, recognition, all that is fine. Yeah, but Shreya got it. It is FX. Okay, so Shreya, it is either FX. You can use the term as, it's not 4x, it's FX, or I think what you were saying. So this is also fine, and also this is also fine. Okay, okay, 4x. Okay, so they get taken advantage of the exchange rate. Now, for example, the rupee and dollar, right? So I think it's around 75 or 76. So they can end up raising more in terms of local currency than they would have if they had issued it here in India. Okay, is this clear with everyone? Okay, okay. Now, the last part of depository receipts, now I really need you guys to pay attention here, is that it can get a little confusing. Okay, so your depository receipts, there are two types of DRs. Okay, sorry, two types of depository receipts. Okay, the first one is called as sponsored depository receipts. Okay, now when we talk about sponsored depository receipts, right, is the shares are issued by the company to raise capital. So the example that I just gave you is a sponsored depository receipt. Okay, so two types. Okay, you have a sponsored depository receipt. Okay, so it's issued by the company to raise capital. Okay, So no, Amal, what's happening is that the global custodian will convert the security to a depository receipt issued to the investor in the US. Now the investor has to pay for these shares. They have to pay the money for it. Once the global depository gets the money, then they will convert it and they will make a payment to the local custodian. Okay. Okay. Two types of depository receipts: sponsored DRs. It's issued by the company to raise capital. Is this clear with everyone? Okay. Now the next one. Hang on. Okay, the next one is what we call as a unsponsored depository receipt. Okay, now the unsponsored depository receipt is issued by the global depository to meet the high demand. Okay, to meet the demand of the US markets. Okay, and why do they do it is to stabilize the price between both the markets. Okay, and it is traded in OTC. Now, the person who holds a unsponsored DR, right, does not get ownership, does not get voting rights or dividends. The only thing that they receive is capital appreciation. Okay. So let me repeat again. Sponsored depository receipts are issued by the company to raise capital. Okay. So this example that I've given you here, company A and all of this, that's a sponsored depository receipt. Okay. Now an unsponsored depository receipt, right, happens between the global depository and the investor in the US. Okay. So what happens and why do they issue it is that it's to meet the demand of the depository receipts in the US markets, right? So what happens is that if the demand is very high, but you got so company if the company is not issuing more DRs and the demand for the company DRs go up, right? So what happens is that the global depository will issue unsponsored DRs to stabilize the price between both the markets. Okay, basically the stock price of a American depository receipt, the company price should be the same in both markets. Okay, it should be the same or approximately the same. Okay, now if you own an unsponsored, you don't get ownership or voting rights or dividends. The only thing you get is capital appreciation, basically when you sell it to somebody else in the market. So Amal, that's what I'm saying, right? Is that you are looking at the current FX rate and you'd convert that to dollar, and that is what it gets issued at. Right? Now let me see if I can pull an example. Are you guys clear with this? Okay. Let me give you guys an example. Give me 1 second. I'm pulling up an example. Okay. I hope you guys can see the last line. Is it okay if I scroll up? Okay, let me scroll up and then I'll scroll back down. Okay. So if you look at this, right, Infosys ADR, the current ADR, the price of Infosys is 9.28. Okay. Now, when we look at, and what is the current price of Infosys in India is 7.05. Yes. Now let's see. 1 second. Okay. Now let's take 9.28. Sorry, computer is so slow. 9.28 into what was the FX rate? 75.83. 75.83. Okay, so you guys look at this, it's 703.70. And if you look at this, right, the price is 715. Okay, now I'll tell you why the difference is, okay, is that on so Thursday, Indian markets closed and Infosys closed at 715. Okay. Now what happened was that the US markets, right? If you guys notice the US markets, it crashed on Thursday because the number of people who have lost their jobs have increased. Okay. So the prices have come down. But and plus Friday yesterday was May Day, so there was no market trading. So the price right now is at an imbalance. But if you keep looking at the Infosys ADR and Infosys here in India, right, and if you use the FX rate, you'll approximately get the rate of what is here in India. Okay. Now there's a big difference between 703 and 715. Okay. But when you look at this from next week, like let's say Monday, Tuesday, Wednesday, there'll be slight differences, not such a big difference. Okay. So is this clear on in terms of the price and the FX rate and all of that? Okay. So no, Amal, you again, you cannot buy these. See, you gotta understand that these are only issued in the U.S. So if you buy local equity here in India, you cannot go to U.S. and sell it, or you cannot buy it from the U.S. and you can sell it here in India. Yeah. Okay. It's just an example to help you understand. Okay. But please write all of this down if you've not done so. And in the meantime, I'll take attendance. Okay. Are we clear with all of this?
So please shortly recap the unsponsored DRS.
Okay. So unsponsored, again, it's issued by the global depository, not by the company. And the reason why they do it is to stabilize the price between both the markets, between the US markets and the domestic market. So India and US. Okay. And when it is an unsponsored, it's traded on OTC, and you don't have any of the investment benefits that you get if you're a normal equity shareholder. And the only thing you receive is capital appreciation. Okay. All right. I've taken attendance. So Amul, Annette, Anurag, Aparna, Biswajit, Deepesh, Ganesh, Hira, Hemraj, Jackson, Lakshmi, Mirnaik, Mukambika, Rahul, Ritam, Sakshi, Shreya, Saurabh, Shubham, Vibhur. Okay. Did I miss anyone? No. I think everybody's here. Okay. Cool. So again, guys, please ensure that you are studying every day, and also that you finish your assignments as quickly as possible. Okay. Or rather by tomorrow. And tomorrow also we have a fresh topic that we have to cover. Okay. Yeah. No, so Amul, it's kept by DTCC. They will not give it to the company. Okay. All right. So that's it for today. Please ensure that you're studying, and also please ensure that you finish your assignment on time. Okay. Because when I'll pull the report this week, and I'll find out how many of you done it or not done it. Okay. And your email assignments, you can email it to me by tomorrow morning. Okay. Okay, that's fine, Deepesh. Yes, of course, Jackson will be sharing the video. Yeah. So again, I'll send you guys my email ID. As long as you send it to me, I'll be able to see it. Okay. And confirming there are mails. Okay, fine. I can do that. I think largely I received everybody's email, and that shouldn't be a problem. So fine. With these set of assignments, right? I'll confirm back that I've received it. Okay. Okay. Anything else? All right. If that's it, then I'll see you guys tomorrow. Please prepare for the class and come. All right. Okay. Cool. Take care, guys. Bye bye.